I spent the first 2 years of my trading career losing money. Not every day, not every month, but when I looked at my account at the end of each year, the number was always smaller than when I started. And it wasn't for a lack of trying. I bought all the courses, I read the books, I watched hundreds of hours of YouTube videos, I tried every indicator, every strategy, every candlestick pattern that you could possibly imagine. I was doing everything that the gurus told me to do, and I was still failing miserably. And the worst part, I didn't know why. I wasn't reckless, I wasn't gambling, I had a process. I had rules, I was journaling my trades, and I was doing everything right on paper. But every time I thought I had it figured out, the market would humble me again. I'd have a good week, feel like I finally cracked the code, and then I'd give it all back the following week. It felt like there was some secret that I was missing, some piece of the puzzle that nobody was telling me. And it turns out there was. But it wasn't a secret indicator, it wasn't a secret strategy, and it wasn't some hidden pattern that only the pros know about. And in this video, I'm going to tell you exactly what it is. I'm going to show you the one thing that changed everything for me, the thing that took me from 5 years of losing to finally being consistently profitable. And I'm going to show how it can change everything for you too. So let's get into it. All right, so what's the secret? It's this. You don't have a trading problem, you have a data problem. Let me explain what I mean by that, because I think this is the most important thing I'm going to say in this entire video. For years, I was obsessed with finding the perfect strategy, and I thought that if I could just find the right combination of indicators, the right entry signal, the right pattern, then I would finally be profitable. So I jumped from strategy to strategy. I'd try one for a few weeks, I'd have a few losing trades, and then I'd get discouraged and I'd move on to the next one. I tried moving average crossovers, I tried RSI divergence, I tried Fibonacci retracements, I tried supply and demand zones, I tried ICT concepts, SMC, order blocks, fair value gaps, you name it, I tried it. And every single time, the same thing would happen. I'd find a strategy that looked great on the charts, I'd take a few trades, some would win, some would lose, and then I'd have a losing streak, get frustrated, and I'd convince myself that the strategy doesn't work at all. And then I'd just move on to the next one. I was looking for a system that never lost, a system that was right 100% of the time. And because I could never find that, I was in a constant state of doubt. I never truly trusted any strategy because I didn't have any real proof that it actually worked over the long run. Here's what nobody tells you. That proof doesn't come from watching YouTube videos about a strategy. It doesn't come from reading about it in some book. It comes from data, your own data from your own trades. And here's the thing that nobody tells you. No trading strategy works 100% of the time. Not one. Not even the billion-dollar algorithms at Goldman Sachs. Not even the most sophisticated hedge funds in the world. Every single profitable trading system in the world has losing trades, it has losing days, it has losing weeks, and it might even have a few losing months. Profitability isn't about not losing. It's about having a statistical edge that plays out over a long number of trades. Let me give you a simple analogy. Think about a casino. The house edge in blackjack is about 0.5%. That means for every $100 bet, the casino expects to make back about 50 cents. That doesn't sound like much, but the casino runs millions and millions of hands per year, and over millions of hands, that 0.5% edge turns into hundreds of millions of dollars in profit. The casino doesn't care if it loses on any individual hand. It doesn't panic when a player goes on a hot streak, and it doesn't change its rules when it has a bad night. Why? Because it has the data, it knows, with the mathematical certainty that if it keeps running the game, the edge will play out. That's exactly how profitable trading works. It's about knowing with mathematical certainty that if you execute your strategy perfectly over and over again, you will make money. Not on every trade, not every day, but over time, the edge will play out. And how do you get that certainty? Through data. You need to know your numbers. Specifically, you need to know 4 things. Number 1, your win rate. What percentage of your trades are winners? If you take 100 trades and 60 of them are profitable, your win rate is 60%. Number 2, your average winner. When you win, how much do you make on average? Let's say your average winning trade makes you $500. Number 3, your average loser. When you lose, how much do you lose on average? Let's say your average losing trade costs you $250. Number 4, your profit factor. This is the ratio of your total gross profit to your total gross loss. You calculate it by multiplying your win rate by your average winner and dividing that by your loss rate multiplied by your average loser. In the example above, 0.6 times $500 divided by 0.4 times $250 equals $300 divided by 100, which gives you a 3 profit factor. A profit factor of 3 means that for every dollar you lose, you make $3. That is a really, really good profit factor. Now here's the critical question. Do you know your numbers? Most traders have no idea. They couldn't tell you their win rate, they couldn't tell you their average winner or loser, and they have no idea what their profit factor is. And without that data, you are flying blind. You have no way of knowing whether your strategy actually has an edge or whether you've just been getting lucky. This is the core problem, and this is why 99% of traders fail consistently. They're trading based on feelings, not based on facts. They think a strategy is working because it feels like it's working. They think a strategy isn't working because they just had a few losing trades. But feelings are not data. And without data, you cannot make rational decisions about your trading. And once I understood this, everything changed for me. I stopped jumping from strategy to strategy. I picked one strategy, committed to it, and I started tracking every single trade. Win rate, average winner, average loser, profit factor, maximum drawdown, everything. And for the first time, I actually had clarity. I could see whether my strategy actually had an edge. I could see where I was deviating from my plan. I could see exactly what was working and what wasn't. And that clarity is what turned me from a losing trader into a profitable one. So before we go any further, I want you to ask yourself, do you know your numbers? If you don't, that's the first thing you need to fix. Everything else is secondary. All right, so now that you understand the foundation, you need a rules-based strategy that you can track, measure, and optimize over time. Let me show you the strategy I use. And I want to emphasize something before I do it. This is not a complicated strategy. It's not a collection of 20 different indicators, and it's not some secret technique that only a handful of traders know. It's simple, and that simplicity is a feature, not a bug. Because the simpler your strategy is, the easier it is to execute consistently, and consistent execution is the only way to let your statistical edge play out. My entire strategy is built on one concept: liquidity. I learned this strategy from my mentor who spent over 30 years at Goldman Sachs. And what he taught me fundamentally changed the way I see markets. He told me that institutions, hedge funds, the banks, the market makers don't care about RSI, they don't care about trend lines, they don't care about the patterns that the retail traders obsess over. They care about one thing: where are the orders? Institutions are moving massive amounts of money. We're talking hundreds of millions, sometimes even billions of dollars in a single position. And when you're moving that kind of size, you can't just click buy and sell and get filled at the price that you want. You need liquidity. You need sellers on the other side of your trade. And to find those sellers, you need to engineer a move to a place where you know there are a lot of orders sitting. And where are those orders sitting? At key levels, at previous highs and lows, and at places where retail traders have their stop losses clustered. Once you understand this, the market starts to make a lot more sense. These moves that seem random, the ones where price spikes down to your stop loss and then immediately reverses, they're not random at all. They're engineered. Institutions are pushing price to these levels to collect the liquidity they need to fill their positions. And once you know this, you can trade with them instead of against them. So here's how I apply this to my actual trading. Every single morning before the market opens, I do one thing. I mark my key levels. The first type of levels that I mark out are untested session highs and lows, meaning session highs and lows that have not yet been hit yet. So we're going to mark out this high right there, and then we marked out this low, which you can see we actually took a beautiful trade off of right there, meaning that level was tested, but I have it up right here just for example's purpose to show you how powerful these levels are. Another level that I will mark out and take trades off of is the first 15-minute candle from 8 to 8:15 a.m. Eastern Standard Time. Right here, you can see that I took a nice trade off of this level. The key thing with my highs and lows is that I'm marking out untested levels, meaning levels that have not yet been hit. So we would mark out this high, right? But then this level got hit. So we'd actually go ahead and we'd look at these highs from back here, and we'd look to take trades off of them. This next level is very simple. This is the first 15-minute candle from 8 to 8:15 a.m. Eastern Standard Time. All I do here is I look for a break either to the upside or to the downside. Whichever direction we break to is the direction that we target. Yesterday we broke out to the upside, so we got a retest of the midpoint. I took some longs. I targeted 20 points and I made about $14,000 off of this trade. The reason this works is because you have to think about what happens at 8 a.m. The New York session opens and retail traders who have been waiting all morning start taking positions. Some go long, some go short, and they all put their stop losses just outside the range of that first candle. The trader who went long puts their stop just below the low of the 8 to 8:15 candle. The trader who went short puts their stop just above the high. And what do the institutions do? They push price to one side of that range to collect the stop losses, and then they reverse and go the other direction. So I mark the high, the low, and that midline of that first candle from 8 to 8:15 a.m. Eastern Standard Time, and then I wait. The only other setup I will look for is a bounce off of an untested low, which is exactly what it sounds like. Price approaches an untested low, shows strength on the lower time frames, we enter, and then the only other setup I will use is a rejection off of an untested high. This is literally a direct opposite setup of the setup we just looked at, a bounce off of a low, but we are taking shorts when price reaches a high. I have some videos on my channel where I go more in depth, but that's the entire strategy. 3 setups, a handful of levels, 1 to 2 hours of screen time per day. It's simple, it's rules-based, and because it's rule-based, I can track every single trade and build the data I need to know with certainty that it has an edge. And the data confirms it over hundreds of trades. This strategy has a win rate of above 60% and a profit factor above 2. The math works and the edge is real. But knowing the strategy is only part of the story, because even with a profitable strategy, most traders still fail, and I want you to understand exactly why. I've talked to hundreds of traders over the years, and I've noticed that the ones who fail, even the ones who have a genuinely profitable strategy, all fall into the same exact traps. These are not random mistakes. These are predictable, systematic failures that are baked into human psychology, and until you understand them, you will keep making them. The first downfall is inconsistent execution. This is the one that most traders don't even realize is happening to them. You can have the best strategy in the world, but if you don't execute it perfectly every single time, you are not going to see the results. Let me give you a concrete example. Let's say your strategy has a 65% win rate in backtesting. That means if you take 100 trades following your strategy to the T, you are going to win 65 of them, or 65% of them. But in real life, you don't execute perfectly. Maybe you miss a trade because you stepped away from your desk. Maybe you hesitate on an entry because you're nervous. Maybe you take a trade that's not quite your setup because you have FOMO and the market is moving. Let's say you only execute your strategy perfectly 80% of the time. The other 20% of the time, you're either missing trades or taking trades that aren't even a part of your plan. That 20% deviation can completely destroy your edge, because the 20% of trades you're missing might include some of your biggest winners, and the extra trades you're taking that aren't part of your plan are random, they have no edge, and they're adding noise to your results. So suddenly your 65% win rate now becomes a 45% win rate because you're not executing consistently. You didn't fail because your strategy was bad, you failed because your execution was inconsistent. And the frustrating thing is, most traders don't even track this. They don't even know how often they're deviating from their plan. They don't know how many trades they're missing. They just know that their results do not match their expectations. And then they blame the strategy. The second downfall is emotional decision making. This is a big one, and I want to spend some real time on this because I think it's the most underestimated problem in all of retail trading. Trading is one of the most emotionally intense activities that you can engage in. Every time you put on a trade, you're putting real money at risk, and your brain, the same brain that evolved to keep you alive on the savannah, treats financial loss the same exact way as it would treat you getting chased by a bear or physical danger. When you're in a losing trade, your brain releases cortisol, your fight or flight response activates, you get tunnel vision, and you literally enter a mode where you feel so many different emotions. And lots of times, your rational thinking will completely go away. And when you're in a winning trade, your brain releases dopamine, you feel euphoric, you get overconfident, and you start taking risks that you normally wouldn't take. These are not character flaws, they are biological responses that you simply cannot live without. Let me show you how this plays out in practice. Let's say that you have a bad week, you have 3 losing trades in a row, and your account is down 5%. What happens? You start second guessing your strategy, you start wondering if it still works, you start looking for reasons not to take the next trade, and when the next setup appears, a perfect textbook setup, you hesitate and you don't even take it. And of course, that trade would have been a winner, a big winner that have recovered all of your losses and then some. But you missed it because you were scared, and now you have FOMO, so you're gonna revenge trade and try to get into other trades. Now flip it around. You have a big week, 3 big winners in a row, your account's up 15%. What happens? You feel invincible. You start thinking you figured it all out, you start taking bigger positions, and you start taking trades that are slightly outside your rules because now you're super confident. And then you give back all your profits in one bad trade because you were overconfident and over-leveraged. I've lived both of these scenarios multiple times, and I can tell you, there's no amount of discipline or willpower that can fully protect you from these emotional cycles. They are the nature of being human. The third downfall is the inability to scale. Let's say you've somehow overcame the first 2 downfalls. You have a profitable strategy and you're executing it with discipline. Congrats, you're now in the top 1% of traders in the entire world. But you now face a problem. You can't scale. Think about what your trading life actually looks like. You wake up at 7:30 a.m., you sit at your desk, you mark your levels, you watch the market from 8 to 11 a.m., you take your trades, and then you're done for the day. That's 2 to 3 hours of actual trading, but you're also spending time reviewing your trades, updating your journal, watching the news, and managing your psychology. In total, you're spending maybe 4 to 5 hours per day on trading, and your income is directly tied to those 4 to 5 hours. If you wanted to make more money, you need to trade more. But you can only trade for so many hours before you burn out, and a lot of you guys have work, you have a family, you have things you have to do. You can only watch so many charts at once, and you can only manage so many positions simultaneously. And because of this, your income has a ceiling, and that ceiling is determined by your personal time and your energy. You've essentially created another job for yourself, a job that requires you to show up every single day, sit at a screen, and execute manually. If you want to go on vacation, you don't trade. If you get sick, you can't trade. If you have a family emergency, you can't trade. This is not financial freedom. This is a different kind of prison. And here's the thing that really gets me. Most traders just accept this as the reality. They think that this is just how trading works, and they think that the goal is to get good enough that you can make a living from those 4 to 5 hours per day. But that's not the ceiling. That's just the ceiling for manual trading. These 3 downfalls, inconsistent execution, emotional decision making, and the inability to scale, are the reason why 99% of traders never make real, life-changing money. And they're not problems of strategy or trading, they're problems of being human. And that's the thing that they'll never tell you in the courses and the YouTube videos. They teach you strategies all day long, but they never address the fundamental problem, which is that the human executing the strategy is the weakest link. Looking back on my first 5 years of failure, I can see very clearly what I was missing. I had the work ethic, I had the discipline, I had the desire. What I didn't have was the right framework. If I could go back and talk to my younger self, I would tell him 3 things. First, stop looking for the perfect strategy. The strategy is not the problem. Any simple rules-based strategy with a genuine edge will work. The opening range break and retest I showed you earlier, that works. Session level reaction, that works. There are dozens of simple, profitable strategies out there. The problem is not the strategy. The problem is that you never stick with one long enough to let the edge play out. You need 200 to 400 trades of data before you can actually evaluate a strategy. And most traders don't get there because they quit after 10 to 20 trades. Pick a strategy, commit to it, get the data, and then optimize it. Second, focus 80% of your energy on execution and data, not on finding new strategies. Once you have a strategy, your only job is to execute it perfectly and track everything. Every trade, every entry, every exit, every deviation from your plan. Because here's what happens when you do this. You start to see patterns in your own behavior. You start to see that you always hesitate on trades that come after a losing streak, and you start to see that you always overtrade on Fridays. You start to see that your best trades are always in the first setup of the day, and your worst trades are always the ones that you take out of boredom in the afternoon. This self-knowledge is worth more than any strategy because it tells you exactly where you're leaking money and how to fix it. Third, and this is the one that would have saved me years of pain, find a way to remove yourself from the execution process. This was the biggest realization of my trading career, and it took me 5 years to get there. I was the weakest link in my own trading system, not the strategy, me. My emotions, my inconsistencies, my human error, my need to sleep, my inability to be in 2 places at once were the only things holding me back. My strategy was profitable, my execution was not. And the solution was not to try harder, the solution was not to be more disciplined, the solution was to find a way to let the strategy run on its own without any interference. To let the data-driven edge play out without any human emotions getting in the way. And that's when I discovered the truth that changed everything. The truth is that every single problem that I just described to you is solved by algorithmic trading. And I want to be specific here because I think a lot of people have a misconception about what algorithmic trading actually is. Algorithmic trading is not some mysterious technology that only hedge funds can use. It's not a black box that makes random decisions, and it's not gambling dressed up in code. Algorithmic trading is simply this. You take your rules-based strategy and you translate it into code and you let a computer execute it for you. That's it. The same strategy I showed you earlier, the opening range break and retest, the session level reactions, those exact same rules can be coded into an algorithm that executes them automatically and perfectly every single time. And when you do that, something remarkable happens. Let's go back to the 3 downfalls. The first downfall is inconsistent execution. An algorithm solves this because it executes with 100% consistency every single day. Every time a setup meets the criteria, it takes the trade. It doesn't get distracted, it doesn't hesitate, and it doesn't have FOMO. It doesn't miss trades because it stepped away from the desk. The result is the statistical edge you discovered in your backtest is actually realized in live trading. You're not leaving money on the table anymore because of human inconsistency. The 65% win rate in backtesting becomes a 65% win rate in live trading because the execution is perfect. The second downfall is emotional decision making. An algorithm does not have emotions. It doesn't get scared after 3 losing trades in a row. It doesn't get overconfident after 3 winning trades. It doesn't revenge trade, it doesn't cut winners short, and it doesn't let losers run. It is completely immune to the psychological warfare of the market. It removes the weakest link, you, from the equation entirely. Think about what that means. Every single bad trade you've ever made because of fear or greed, an algorithm would have avoided. Not because it's smarter than you, but because it simply doesn't have the emotional response that caused you to make the bad decision. The third downfall is the inability to scale. An algorithm can run 24 hours a day, 7 days a week, without ever getting tired. It can monitor hundreds of markets simultaneously, and it can manage dozens of accounts at the same time. Your income is no longer tied to your personal time and energy. The algorithm is working while you sleep, it's working when you're on vacation, it's working while you're spending time with your family. You've gone from a job where your income stops the moment that you stop working to a system a system that generates returns regardless of where you are or what you're doing. This is the difference between trading for a living and actually building wealth. And here's the thing that really blew my mind when I first understood this. The strategy doesn't change. The edge doesn't change. The only thing that changes is who's executing it. Instead of you sitting at a desk, fighting your emotions, missing trades, and capping your income, a computer is doing it perfectly, consistently, and at scale. This is the future of retail trading, and the traders who understand this now are going to be years ahead of the traders who don't understand this. The gurus are still selling you courses on chart patterns and indicators, and those things have their place, but the real edge, the institutional edge, has moved on. The game is no longer about who can read a chart better. It's about who can build and deploy the better system. And for the first time in history, the tools to do this are available to retail traders like you and me. You don't need a team of developers. You don't need millions of dollars in capital. You need a proven strategy, a way to translate it into code, and then a way to execute it. That's it. Now I know what you're thinking. This sounds great, but I'm not a programmer. I don't know anything about coding and algorithms. And that's the final piece of the puzzle. For the past 2 years, my team and I have been focused on one thing: taking the profitable data-driven strategy that I showed you in the video and turning it into a suite of fully automated algorithms that trade for you. We've done the coding, we've done the backtesting, we've done the optimization, we've deployed them in live markets and on funded accounts, and we've built systems that solve every single problem I talked about in this video. I've put together a separate, in-depth presentation that shows you exactly how it all works. In that video, I will break down our 4 core trading algorithms and the specific setups that each one trades, along with the complete backtest results for each one, the real unfiltered data, not cherry-picked highlights, live performance data from our own funded accounts showing exactly how these algorithms execute in real time, and how our done-for-you model works, where we install and manage these algorithms for you so you don't have to touch a single line of code. If you're tired of the cycle of hope and disappointment, and if you're ready to stop trading based on feelings and start trading based on data, and if you want to see what's actually working in 2026, then you need to watch this video. Click the link in the description below. It's completely free, and I promise you this will be the most valuable 30 minutes you spend on your trading this entire year. This is the information that I wish somebody had given me 5 years ago. It would have saved me so much time, money, and frustration. Do not make the same mistakes that I did. Click the link. I'll see you on the other side. Thank you all for watching this video. Talk soon.